All right, let's jump right into it. Today, we're tackling one of the biggest questions out there for investors. How much of your portfolio should really go into alternative assets? Things like private equity, real estate, all that stuff. It's a huge question, so let's get you some answers. So what's the magic number, right? That's what everyone wants to know. Just give me a percentage I can plug in and be done with it. Should it be 5%, 10%, maybe even 25%? Look, if you're exploring the space, I'll bet this is the number one thing on your mind. Well, here's the honest truth, and it's a big one. There is no single magic number. I know, not the answer you wanted. But the right allocation is super personal. But don't worry, we're not just going to leave you hanging. The whole point here is to give you a framework, a kind of roadmap, so you can figure out what your number is. All right, section 1, what the experts suggest. To get started, let's take a look at the general benchmarks. Seeing what the pros and the big institutions are doing, that's a really great place to start. It gives us a solid frame of reference. So first things first, you've got to understand that not all investors are playing the same game. It's like they're in totally different leagues. On one side, you've got the average retail investor, which is, most of us. And on the other side, you've got the heavy hitters, the high net worth folks and massive institutions like university endowments. Their goals, their money, their timelines, completely different world. And this is where it gets really interesting. Just look at the difference here. For everyday investors, advisors usually recommend a pretty modest 5 to 15%. But then you look at the institutions. Wow, we're talking 20, 30, even up to 50% or more. Legendary endowments like Harvard and Yale, they have over half their money in alternatives. So why the huge gap? It's simple, really. They can play the long game. They have decades to let their investments grow and can handle way more risk than the average person. Okay, so what does this mean for you, especially if you're just starting out? Well, if that 5 to 15% range still feels kind of high, the advice is pretty simple. Start smaller. There is absolutely nothing wrong with that. An allocation of just 1 to 5% is a perfect way to just dip your toes in the water. You get to learn the ropes and see how these things work without taking on a ton of risk. Okay, part 2, your personal allocation factors. So we've got the general guidelines down, but now we get to the most important part of this whole thing, which is you. We're shifting gears from what everyone else is doing to figuring out what's right for your specific situation. Let's think of this next bit as building your own personal compass. So this personal compass of yours, it basically points in 4 key directions, and you need to be really honest with yourself on each one. We're talking about your risk tolerance, your liquidity needs, like how quickly you might need your cash, your time horizon, and last but not least, your own knowledge and experience. Let's break them down one by one. All right, number 1, risk tolerance. Seriously, this is the foundation of your entire strategy. So you have to ask yourself, are you the kind of investor who's willing to ride some pretty big waves for a shot at higher returns? Or are you more of a sleep well at night investor who's focused on making sure your money is safe? Be honest. Your answer here is going to be a huge factor. Second point on the compass, your liquidity needs. This one is critical. A lot of these alternative assets are what we call illiquid, and that's just a fancy way of saying you can't get your money out quickly. It's not like a stock you can sell in seconds. So can you really afford to have a chunk of your money tied up for, say, 5, 7, maybe even 10 years? If you think you might need that cash for a big life event, like a down payment or tuition, then you've got to keep that allocation low. Number 3 is your time horizon. And let me tell you, time is probably your greatest superpower as an investor. Think about it. If you're, say, 30 years away from retirement, you've got a massive runway. You can afford to ride out the market's ups and downs. A long time horizon basically gives you the breathing room to handle the volatility that often comes with alternatives and just let them do their thing over the long haul. And finally, the 4th point on our compass, your knowledge and experience. And please don't skip over this one. How well do you really understand what you're buying? Do you get how private credit works or infrastructure funds? Because let's be real, investing in something you don't understand is just a recipe for disaster. If you're new to all this, it's so much smarter to start with things that are easier to get your head around and then build up from there as you learn more. All right, so let's get to your final takeaway. We've gone through the expert advice, we've built your personal 4-point compass. Now it's time to put it all together and figure out what this all means for you. So here is it, the key takeaways. First, and this is the most important thing, there's no right answer for everyone. This is a totally personal journey. Second, think of those expert numbers we looked at as a guide, not a strict rule you have to follow. Third, It's your compass, your personal feelings on risk, your cash needs, your timeline, and your own knowledge. That's what really matters. That's what will give you your number. And finally, and I really mean this, if you're new, start small. There's zero shame in that. The goal is to learn as you go. And that brings us to the final question, the one we'll leave you with. You've got the framework now. You know what the pros are doing, and more importantly, you have the 4 questions you need to ask yourself. So the only thing left to do is actually do it. Take some time, really think through those 4 points. So, what does your personal compass say? Where is it pointing you?